If you ever win the lottery, he says, never take the lump sum, spread it out, protect it, make it boring. Which is a strange thing to hear from the one billionaire who built his entire fortune on a single insane bet on the internet, and then somehow found a way to protect it anyway. This is the story of how Mark Cuban turned a company nobody understood into a $5.7 billion payday, protected it from the biggest crash in internet history, and is now spending his fortune trying to take down the industry that decides what your medicine costs. Mark Cuban was born in Pittsburgh in 1958, the son of an upholsterer who spent his days fixing car seats for a living. There was no seed money waiting for him, no family business to inherit, no connections to Wall Street. At 12 years old, he was already selling garbage bags door to door because a neighbor told him something that stuck with him for the rest of his life. It's easier to sell people something they already need than to convince them they need something new. His father made him a deal that sounds almost too on the nose in hindsight, $1 for every 100 pages he read. Cuban has said, more than once, that deal is what turned him into an obsessive reader, a habit he still credits for most of what he actually knows about business, technology, and law today, long after any classroom could take credit for it. He enrolled at Indiana University, worked odd jobs through college, bartending, disco dancing lessons, anything that paid, and graduated in 1981 with a business degree and almost no money. He moved to Dallas because rent was cheap, and ended up sleeping on the floor of a 3-bedroom apartment shared with 6 other guys because none of them could afford a place of their own. His first real job out of college was working at a bank, followed by a stint bartending, and he got fired from that one for closing the bar early to chase a sales meeting for a software deal he thought he could close. Most people would call that a red flag on a resume. Cuban took the instinct behind it, sell people what they already need and don't wait for permission, and built it into a company called Micro Solutions, reselling software to small businesses that barely understood what a computer was supposed to do for them. In 1990, he sold Micro Solutions to CompuServe for $6 million. On paper, that was supposed to be the whole story. A nice exit before 32, an early retirement, maybe a life of angel investing on the side. Instead, it was just the opening chapter. In 1995, Cuban put a chunk of that $6 million into a tiny startup founded by Christopher Jabe called AudioNet, a way to stream local radio broadcasts, including Indiana University basketball games, over something almost nobody outside of a university lab had heard of yet: the internet. Cuban took over, brought in his old college friend Todd Wagner, and together they renamed the company Broadcast.com. 3 years later, in 1998, Broadcast.com went public. Its stock jumped 250% on the very first day of trading, one of the biggest single-day gains Wall Street had ever recorded up to that point. Overnight, on paper, Cuban's stake in a company most Americans had never heard of was worth roughly $300 million. But the number that made the headlines came 9 months later. In April 1999, at the absolute peak of the dot-com bubble, Yahoo announced it was buying Broadcast.com for $5.7 billion, paid entirely in Yahoo stock. Cuban and Wagner split roughly a third of that between them. Cuban was 41 years old, and he was, suddenly and officially, a billionaire. Not from decades of running a public company, but from a streaming radio site he'd co-owned for less than 4 years. There was just one catch buried in the fine print. Yahoo's lockup agreement meant Cuban legally could not sell, or even hedge, a single share of that stock for 6 full months. And as he watched companies like Pets.com and Webvan burn through hundreds of millions of dollars with no real business underneath any of it, Cuban started to suspect the entire market was about to fall off a cliff, possibly before his lockup period even expired. Here's where most people expect this story to fall apart, because almost every founder who got paid in stock during the dot-com bubble lost nearly everything when it burst. Todd Wagner did well. Plenty of other dot-com millionaires didn't. That's not what happened to Cuban. And the reason isn't luck, and it isn't timing either. It's one specific, deliberate financial decision. The moment his lockup expired, Cuban built what Wall Street calls a collar. He bought put options that guaranteed him a minimum price on his shares no matter how far Yahoo stock fell. And he sold call options to help pay for those puts, which capped how much higher he could ride the stock if it kept climbing. In plain terms, he voluntarily gave up his unlimited upside in exchange for a guaranteed floor under his fortune. At the time, people close to him thought it was a mistake. Yahoo stock was still climbing, eventually touching $237 a share. His hedge had locked in a price nowhere near that peak, and for a few months, it genuinely looked like he'd left billions of dollars sitting on the table for nothing. Then, in March of 2000, the bubble popped. Yahoo's stock collapsed from that $237 peak down to around $13 a share within 2 years, a 93% crash. Founders who held onto their stock the way conventional wisdom told them to watched almost their entire net worth disappear in a matter of months. Cuban didn't. Because of that one hedge, he walked away with more than $1 billion in guaranteed, liquid cash while the rest of the internet burned around him. Wall Street would later call it one of the 10 best trades in its history. Cuban himself has said, more than once, that the hedge alone ended up making him more money than the entire $5.7 billion Broadcast.com sale. That same month, January 2000, right as Yahoo's stock started its slide, he used part of that protected fortune to buy a struggling, mismanaged NBA franchise for $285 million, the Dallas Mavericks. He's joked since then that a single day's gain on his hedged Yahoo position covered the entire purchase price of the team, twice over. 23 years later, in December 2023, Cuban did something that surprised almost everyone all over again. He sold the majority of the Mavericks. The Adelson and Dumont families, who run Las Vegas Sands, the casino and resort company, paid $3.5 billion for roughly 70% of a team he'd bought for $285 million. That's a return of over 1,100% on the 2+ decades he held it. He kept about 27% of the franchise, and he says he was verbally promised control of basketball operations forevermore. Since then, that promise has turned into a very public fight. Reporting this year describes Cuban clashing with Patrick Dumont, the team's new governor, over decisions tied to the Mavericks' planned new arena. And Cuban has admitted, on the record, that he regrets parts of how the sale was structured, saying he made a lot of mistakes in the process. Even the man who mastered the exit didn't get every exit right. A year after that sale, in 2025, he stepped away from Shark Tank 2 after 13 seasons as its richest and most recognizable investor. Not because of a scandal, because he wanted a couple more summers with his teenage kids before they left for college. It's a strange thing to hear from a man built on relentless hustle, and it's exactly the quote you'll find at the top of every article asking why he actually left the show. Because the truth is, he didn't step back to slow down. He stepped back to focus on the thing he'd already been building since January 2022, cost plus drugs. The pitch is almost insultingly simple. Cuban's pharmacy publishes exactly what it paid for a medication, adds a flat 15% markup plus a small dispensing fee, and that's the final price. No hidden markups, no secret rebates buried inside a supply chain nobody outside the industry understands. It's a direct attack on pharmacy benefit managers, the middlemen who control roughly 80% of every prescription filled in America and have never had to explain their pricing to a single patient. Cost Plus Drugs now works with Blue Shield of California, with Humana's Centerwell Pharmacy Network, and, in one of the more unexpected partnerships of the year, with the current administration's own Trump RX initiative, putting Cuban's name next to a White House drug pricing push most people never saw coming. As of 2026, Forbes puts his net worth at roughly $6 billion, ranking him among the top 700 billionaires on the planet. Still a billionaire, still one of the richest people to ever sit at that Shark Tank table, just increasingly less interested in reality TV and box scores, and more interested in picking fights with entire industries at once. Even his most recent public appearances follow the same instinct that saved his fortune back in 2000. On a widely watched podcast this year discussing the hundreds of billions pouring into artificial intelligence, he was one of the only guests in the room actually asking the uncomfortable question, where's the hedge, and who's protected if this bubble pops the way the last one did? Which, if you've been paying attention for the last few minutes, should feel very familiar by now. I keep a running list of founders who saw their own version of that crash coming and did nothing to protect themselves anyway. The ones who had every single warning sign in front of them and still went all in with no floor underneath. Those cases don't make it to the channel, I saved them for the newsletter, alongside the actual math on exactly how big Cuban's hedge turned out to be. Every founder who got wiped out in 2000 believed the same thing Cuban did, that they'd built something real and that the market agreed with them, right up until the moment it didn't. The difference between the ones who survived and the ones who didn't was never really about the belief. It was about what they did with the win while they still had it in hand. The market doesn't reward the person who correctly calls the top. It rewards the person who assumes they might be wrong about the timing and builds a floor under themselves just in case they are. That's true whether you're sitting on a $5 billion stock payout, a fast-growing NBA franchise, or a pharmacy company betting it can outlast an entire industry designed to protect its own margins. So the real question was never just whether Broadcast.com or the Mavericks or Cost Plus Drugs was the right bet in the moment. It's whether, when a bet like that actually pays off, you're disciplined enough to stop being a hog and take the trade that protects what you already built, instead of the one that simply feels like more. I keep the more polarizing breakdowns, the deals I can't fully back up with public numbers, and the founders who didn't get Cuban's ending, for my mailing list, not for the channel. If you want those, the link's below. And if you want to see what happens when a founder makes the opposite bet, no hedge, no floor, all in, I've got that video queued up right here.